Good morning, everybody. This is a live market open for Friday, February 5th. Sorry again for the short delay. Anyway, we're starting almost on time. Today is non-farm payrolls day. I'm Yohay Elam, a Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. As always, we'll talk about what's going on in markets, talk about some charts, answering, of course, your questions, the most important thing. And as we do every Friday, we'll do a preview of next week's events. But before next week, we have, of course, today the big event, the non-farm payrolls. So let's begin with what's going on in markets. On Wednesday, we had the dollar crash, dollar dive, the buck broke down, whatever you want to call it. Yesterday, we had a continuation of that during the European morning, but afterwards, we had some stabilization in the dollar. Okay, we had some market sort of finding some ground, the dollar finding some footing, and some tension building up towards the non-farm payrolls. I believe we will see a little bit of choppiness before the non-farm payrolls, and then, of course, when we'll have the news, things will begin moving again. And I also wrote here light risk off, because the stabilization is a bit characterized by stronger euro and stronger yen, while commodity currencies are sliding just a bit. But the big move of this week, seen on Wednesday, was a crash of the US dollar on Wednesday, and this crash was across the board. This move was much stronger than any kind of risk on, risk off that we had in previous kind of days. We always talked about if it's a good mood, we have a stronger dollar against the euro and the yen, and weaker against commodity currencies, and the other way around. This week was characterized by a break of all these correlations, the risk on, risk off, at least on Wednesday and early yesterday and Thursday, just a crash of the dollar. Okay. And another thing I wanted to highlight, there's some talk about oil inventories reaching full capacity. That means that the next production of oil will just have nowhere to go. The trucks, the trains, the ships will have to sell it at any price. I don't know how real it is, but just something to take into account. Let's dive in to a bit of charts, okay? So everybody's favorite euro dollar. This is the big move to the upside, seen on the crash on the ISM non-manufacturing PMI coming out worse than expected on Wednesday. Here we had some stabilization, and that's yesterday's move. Yesterday we had another break to the upside during the European session and the also early US session, above 111.45 and temporarily above 112.15. I still see 112.15 as resistance. Okay, and this is the range for me, 111.45 to 112.15. Remember that towards the non-farm payrolls, we will have more of these kind of bars of candlesticks, very, very stable ones, okay? Further topside, 112.90, downside, 110.70, okay? The lines, at least to the downside, are very clear. Upside, we're back to levels seen in October. Pound. Yesterday, we had an interesting event from the pound. So we had the Bank of England making its Super Thursday, okay? We covered it live on FX Street, Valeria and I, and that's an opportunity to invite you all to join the live coverage of the non-farm payrolls today at, I think it's 1 GMT, half an hour before the non-farm payrolls. Anyway, what did we have yesterday? We had the pound continuing to climb on the weakness of the US dollar, and then we had a dovish decision from the Bank of England, okay? I think I talked about that. It was not a big surprise, but it still hurt the pound just a bit. We had three events: rate decision, of course, no change in policy. The second thing we had is we had the voting pattern, the meeting minutes, and these showed 9 votes against any change and 0 for change. It's a change from previous votes. In the past, we had 1 member voting for a rate hike and Ian McCafferty and all the rest against. Ian McCafferty aligned with his colleagues. He's no longer calling for a rate hike, okay? So that was a bit dovish, not totally unexpected, but dovish. And the quarterly inflation report, the number 3 in the Super Thursday, this showed lower forecasts for inflation, lower forecasts for growth, worries about the global economy. Of course, China, but also the Eurozone. Something they didn't say, but they are worried, of course, is about the EU referendum. If the UK is out, it's uncertainty for business. And the uncertainty about the referendum, of course, is trouble. But anyway, we had this dovish move in the pound, but nothing could stop the weak dollar. Okay, so we had this slide here to the downside, this needle here, and then we had it rise back to the upside. Okay, because the weakness of the dollar was overwhelming. Okay, it was really a killer for I mean, it took over all the dovishness of the Bank of England. Okay, afterwards, and especially this morning, we're seeing a fresh sort of risk-off mood that is mostly hurting the commodity currencies in the pound, helping the yen. The euro isn't moving that much. Okay, so we have a weaker pound this morning as a result of some profit-taking, risk-off, some small reversal of the weakness of the US dollar. Dollar yen, here we actually see some kind of continuation of the trend. Okay, let's look at what we had in the yen in the past 7 days. Okay, last Friday we were here talking about the Bank of Japan announcing a negative interest rate. Okay, that was many expected them to move, but that was a big move, minus 0.1. It shocked the yen, sent the dollar yen all the way up to 121.50. But from there, especially with this weakness of the dollar, we had it fall all the way back down to 117. And recently it fell during the Asian session even below this ground. So finding a bit of stability, but all in all, we're in lower ground here. The Bank of Japan, like Carney, they must be all scratching their heads in frustration. They're going dovish. Carney said no rate hikes, not the time to raise rates. Kuroda actually cut rates, and their currencies are not weakening enough against the dollar. Okay, dollar CAD, very interesting currency pair. I mean, I like it personally. Yesterday it fell all the way to 136.40 with some kind of rise in oil prices, and especially with the weakness of the US dollar. From the peak right here in mid-January, late January, just before the Bank of Canada did not cut interest rates. Good morning, everybody. Then we're already 1,000 pips to the downside, okay? Canadian dollar riding on the weakness of US dollar, and also on oil prices. Oil prices are showing some kind of weakness. As I said, there's talk about inventories getting full. We're seeing, I think, some kind of a lower high here in oil prices, WTI crude oil, but here it's a bit more stable. The $30 level is still fought over. Okay, there's talk that Russia said that Turkey might invade Syria, and there's talk about Saudi Arabia sending troops to Syria. It's interesting politically. It has some short-term impact on the price of oil, and of course on the Canadian dollar. But all in all, the basic economics of oil are too much supply, not enough demand, and it's going to accompany us for many months. The big question is it going to turn around in 3 months, 6 months, or 2 years, as some expect? Okay. So in the nearer term, in the next few months, I think there's downside pressure on oil, and therefore the strengthening of the Canadian dollar, which is impressive, maybe will not last too long. Australia, we had well, we're off the highs, 71.80. I still see 72.20 some kind of resistance, even if we had a small break above it. 71.50 is support, followed by 70.50 on the top side. Further on the top side, we have 72.80. We had a disappointing retail sales report from Australia. Good morning, everybody. It came out flat and month over month instead of a rise of 0.3 that was expected. On the other hand, the RBA had its stability report, and that showed that the Australian economy is a-okay. So all in all, a stable picture. Next week, we have the Chinese New Year holiday. So maybe that'll provide some help for the Aussie. No news is good news from China at this point. Okay, so these are the lines to watch. Also, the Kiwi dollar made a move above 67, but never went too far. Now it's back down again under 67. All right, nothing coming out of New Zealand. Earlier this week, we had an excellent, superb jobs report from New Zealand, and that, together with the weakness of the dollar, in terms of, I mean, the Kiwi dollar made the biggest leap against the greenback on Wednesday, 2.6%. Of course, now we're seeing some kind of profit-taking consolidation towards the non-farm payrolls. Dollar Swiss under parity, finding some support at 99.20. Parity is resistance. Remember SNB intervention here. Euro Swiss also off the highs. It reached 112. Currently 111, almost 11. So we're between 110.75 and 111.65, the lines that I see here, and 112 is also resistance. The Swiss National Bank intervenes and cares about this pair more than dollar Swiss. Euro Swiss is important because of Switzerland's trades. Euro pound under 77 went a bit up. Well, this morning, because the pound is weakening once again after it showed the relative strength defying the doves of the Bank of England. 77.40 remains very strong, very tough resistance. It has been a line of support right here. Okay, so if you're trading euro pound, this is a very, very important line to watch. Okay, 77.40. And to the downside, I think we have here 76.60. Yeah, well, it's well, actually quite a significant line. And to the downside, I would say this is a bit weaker already. No, we can leave it here. 75. 75.40 still of importance. Euro yen, the safe haven pair, stabilizes at higher ground. 130.82. 132.25 is strong resistance. 129. 130 is, of course, a round number, but 129 is more significant support because that has been the top of the previous range, 127 to 129. So Kuroda from the Bank of Japan can probably be happy at least a bit because at least the euro is weaker. At least the yen is weaker against the euro, but not against the dollar. Okay, and pound yen. Roller coaster pair. This eventually the yen strengthened against the dollar more than the pound did. So after we topped out at 175, we're back. We fell under support 172 and now battling with 170. The battle is not over. 168.50 and 167 are the next lines of support. Okay. Yeah, we talked about quite a few pairs. Looking forward to your questions about currency pairs, and we'll go. We'll of course continue with the more events we had yesterday, and more importantly, today's big event. Okay. So we talked about the dollar stabilization, sort of, after the big crash, attention towards the NFP. Okay, let's talk about more events. Let's see if I didn't miss anything from yesterday. Draghi, during the show, he spoke, but he showed readiness to act. He talked about his preference to act instead of not acting, okay? Very dovish, but not different than beforehand. Now, there is a show. There is a show. I see your comment. So you can all see it. Please refresh if you cannot see it. And sorry again for the small delay. Anyway, yesterday we had Draghi showing some readiness to act. But again, his dovish words were, first of all, not new. And secondly, they were not, they came on the background of a weakening US dollar, and you just couldn't stop the weakness of the US dollar. You couldn't push the euro down, okay? So euro dollar continued higher. Okay, defying Draghi. Probably was frustrated as well, together with Carney and Kuroda. The Bank of England, we talked about that, was dovish. US jobless claims disappointed just a bit with 285. Factory orders fell 2.9, also a bit worse than expected in the US. Nothing earth-shattering. Okay, we had disappointing figures, but they were not enough to add fuel to the fire. I mean, just a bit, but not like the ISM non-manufacturing PMI on Wednesday. We had a relatively surprising comment from Loretta Mester of the Cleveland Fed. She is a hawk. That was no surprise. She still talked about 4 hikes in 2016. Showed a bit less confidence. She said we'll have to adapt if things change and things like that. But she still said her forecast about 4 hikes in 2016 is relevant. Okay, that was a bit surprising. It did not strengthen the US dollar because she is a known hawk. Yeah. And we talked about Australia. Retail sales were flat, but RBA was balanced. Okay, what do we have today on the agenda? First of all, we had earlier this morning German factory orders. They missed. Let me refresh this so can show you the figures. Why can't I see it? Okay. Yeah, so German factory orders fell 0.7%. Month over month and year over year, they dropped 2.7. Bad news from Germany. They didn't have. Sorry, it didn't have much impact on the euro. It's well, I do think it's an important figure, but not as important as today's non-farm payrolls. Okay, so that's what we have there. Before we'll talk about the non-farm payrolls, I see your question about pound against the Aussie. So let's take a look about that. Both currencies are risk currencies. So if we have a risk on, risk off, they move, of course, together. Let's see if I have, yeah. So we did have some movements, but not as extreme. 202.55 is the current level. I still see, well, perhaps we can put support right here at 201.50, okay? And it's a bit choppy, this pair. In the past, I put resistance here, but I would say it's a bit more here, right? 205.65 would be resistance. What do I think about the next direction of this pair? I think both. I mean, it could trade in range. Okay. Yeah, Germany contracting along with global trade. Baltic Dry Index. Less factory orders. Of course, China is to blame as usual. Anyway, regarding pound Aussie, I think the trend, if we can, it's a bit to the downside in general. If we look at the daily chart, perhaps the weaker pound in recent months because of Carney's not the time to raise rates, and the Australian economy has shown many signs of resilience, supporting despite the Chinese trouble. So Chinese trouble pushed the pair higher, especially in August when the Chinese stock market crashed. Since then, it has been gradually falling back down. Anyway, the levels to watch here are 205.65, 208.30 to the upside. It's a bit choppy. I'm not sure it's the best pair to trade. The round number of 2 is, of course, important, not only because it's very round, but because we fell to support right here just 2 weeks ago, actually. And below this line, we have 195, right? No, 196, okay? So that's what's going on with pound Aussie. I think that the relative strength of the Australian economy and the uncertainty about the referendum in the UK, well, puts the tendency to the downside, but the pair is quite choppy and not sort of very directional. Okay, another question on pound yen. Actually, we talked about pound yen. So we're seeing it sliding back because the pound is weaker than the yen against the dollar. The yen showed a lot of strength against the dollar. All in all, we're seeing a big reversal from this move to the upside, 175. So 170 is still a battle line. 168.50, 167 are the next lines. Pound dollar, we talked about that as well, but let's falling now in range. So general weakness of the pound, 146.50, 148 resistance, 144.80 support. Okay. What else do we have here on the questions? The BDY. Okay. Multi-Dry Index. Okay, thanks. Let's go back to the event we had yesterday and today. We talked about yesterday. So, time to talk about today's main dish, the non-farm payrolls. Okay. I prepared a separate slide for that. First of all, it's at 1:30 GMT. Secondly, it's we're having a live broadcast of that. Dale Pinkert, Valeria Bednarik, Mauricio Carrillo, and myself will be covering it live with all the charts, all the data. I'll be more on the fundamental side, and they'll talk more technical, but we talk about everything all the time. Should be fun in any case. Okay, so please join in. You'll have the link on FX Street, of course, and I'll also publish it on Forex Crunch. Anyway, so what are we expecting this time? 190,000 jobs gained, much weaker than 292,000 last time. Okay, that's not. Last time was a huge positive surprise. Actually, also the report for December 2014 was a huge positive surprise. With over 300,000. So, but now we're back to normal. Okay, so 190,000, 200,000 is okay. It's not terrible. It's still, thanks Dinda for pointing out the live coverage. So we have the 190,000 expected. Now, what are the real expectations? On one hand, if you look at the ADP figure, the ADP figure was better than expected, 205,000 instead of 195. Okay, that implies a better than expected figure because in recent months we had a good correlation between the ADP non-farm payrolls and the actual figure. Okay, but on the other hand, we had the ISM PMIs, both manufacturing and services, non-manufacturing, really pointing to the downside. Okay, we had the manufacturing sector, which is a small sector in the United States, is with many developed economies, but it's the sector that actually produces stuff. Okay, it showed a significant contraction, firing of people, 45.9 points. 50 is the level between growth and contraction, and 45.9 is a really terrible number. The services sector is still growing. Okay, it's the biggest sector in the United States. But it also fell by 4 points from 56.5, if I'm not mistaken, to 52.1, showing a significant slowdown in hiring. Does this imply less hiring in January? Because the survey, this Purchasing Managers Index was for January. Not necessarily so. There might be a lag. The US dollar fell rightfully, and because the worries are correct, because these surveys are significant and they do point to the intentions and to the direction of the US economy. But it might not be seen right now, okay? And now what I've seen from Goldman Sachs, they talked about weaker than expected non-farm payrolls, not because of the ISM PMIs, but because of the average jobless claims, okay? So jobless claims published every Thursday. In the past few weeks, they've been sort of grinding to the upside. Okay, they've been they're still at relatively good low levels, but they're moving to the upside, and this for Goldman Sachs implies worse than expected report. So anyway, it's important to remember headline figure official expectations 190, but real expectations because of the ISM, especially non-manufacturing PMI, despite the lagging effect, could be a bit lower, and despite the NFP, the ADP non-farm payrolls. Okay, so I believe real market expectations are around 180, 170. Okay. Second in line in the report is the wage report. Okay, people have more jobs, low unemployment rate, but wages are hardly rising. Last time, last time it was 2.5, which is at the higher end of the range year over year, okay? It was also the level in October and also in December. It's above the average or above the range we've seen in 2015 and 2014 of between 1.9 to 2.3%. So 2.5 wasn't too shabby, okay? But this time we're expecting a lower level, 2.2. On the other hand, in the monthly figures, we're expecting plus 0.3 instead of plus 0. I think the year over year is more important. I think that if we have year over year remaining at 2.5, even 2.4, it's still good news for the US economy. If it falls to 2.2 and especially to 2%, it's very, very disappointing news, okay? The unemployment rate is expected to stay at 5%. The unemployment rate is important for politicians, but for markets, it's also worth looking at, yeah, but the headline figure of non-farm payrolls and wages are the most important figures to look at. Okay. Want to see my non-farm payrolls chart and levels? Yeah, sure. Just paste it on the chat and we can refer to that, okay? Jax, just talk about a few other figures in the non-farm payrolls report. Worth watching, perhaps not for the immediate reaction. First of all, immediate reaction headline, second wages, and then we have other figures. For example, if we see that the unemployment rate remains at 5%, then we have to look at, okay, does this mean that the participation rate went up? If the participation rate went up, it's good news, because if we have the same level of unemployment, well, more people are participating in the job force, it's good. If we have a fall in the unemployment, but the participation rate goes down, it's meaningless or even bad news, okay? So you just count less people out of job, and it's not real, okay? So that's also interesting. There's a wider unemployment figure called the real unemployment rate, dubbed the real unemployment rate, officially called U6. It also counts discouraged people. It stands currently at 9.9%. Okay, it counts people, they're not working because they've been out of work for a long time and they're just too discouraged to look for a job, or people who are working part-time but want to work full-time, all these kind of things, okay? So that's another figure to watch. Also the average work week, which is quite stable. And one piece of information I look at for long-term trends is the employment to population ratio. Okay, it's the widest measure of employment in the US economy for me, because it just takes all the people and how many of them are working, okay? No division to age or anything like that, just, or discouraged, not discouraged. That has been rising just a bit in 2015 from up to 59.4, if I'm not mistaken. It needs to rise even more. Okay, anyway, from payrolls again. Headline figure, most important, second wages, and then perhaps other figures, okay? Let's go back to other events we have today. At the same time, we also have Canada releasing its jobs report. So for those of you trading the Canadian dollar, this will provide a break from oil that moves the Canadian dollar. Remember, dollar CAD is a very dangerous pair to trade around 1:30 GMT, because we have also the US non-farm payrolls. But of course, the Canadian jobs report is important for the Canadian dollar, not only in the immediate release at 1:30 GMT, but also afterwards. What are we expecting in Canada? No change in the unemployment rate, 7.1. The employment change, net change in employment, is expected to be a modest positive, 5.5 thousand jobs gained, lower than last month's really good report of 22.8. In Canada, there's always a mess between part-time and full-time jobs. I think it can be mostly ignored. And just for comparison, the participation rate in Canada is 65.9 compared to 62.6 in the United States. Just to give some proportion, in Canada, similar economy, same language, the more people participate in jobs. We also have the trade balance figures also from both countries. In the United States, a slightly wider deficit is expected from 42.4 to 43 billion. And in Canada, where's that figure? It disappeared anyway. Trade balance, of course, today will be overshadowed by non-farm payrolls, but I must say that if we do look at trade balance on its own, it's important not only to look at the actual figure if it's a deficit in the United States, it's always a deficit, but also at the level of imports and exports, because this tells us about economic developments. Okay, now I see Jax has put a link to his let's okay. Hope I'm putting the right thing, Jax. Important market levels. It's this chart. Okay, some Friday fun, I guess. Yeah, that's modern art, right? Okay. All right. Thanks, Jax. Anyway, let's get back to. Yeah, remember non-farm payrolls, a few characteristics of this event. It's very messy. Orders are drawn away from markets just before the yeah, it certainly helps. Just before the event, we have choppy movements. Yeah, that makes mine look like simplicity. Thanks. Anyway, what I want to say, non-farm payrolls is always a messy event. We have orders drawn away from markets. We have erratic moves. We have sometimes technical lines broken only to be repaired afterwards. Trade with a lot of care. Don't, in this case at least, don't gamble before the event. Wait for the data to come out. Wait for markets to stabilize. Analyze the figures before jumping in. As we've seen this week, moves are not just one leap and that's it. We had a weaker US dollar across the board. That wasn't just a second. It was a move that continued and continued, okay? Especially with euro dollar that made a nice break to the upside and then continued higher and higher, okay? So please watch out, note that, anyway, if you miss a trade, it's not the end of the world. The market always provides more opportunities, all right? So I want to show you one more thing. That's the implied probability of bond markets for rate hike in the United States. For March, under 8% for rate hike. Looking at April, 80% against. Still in June, the majority against. July, the same. September, the same. November, the same. So goes for December. And if we even look to the first Fed meeting of 2017, okay, we just began 2016, right? 70% against the rate hike in February 2017. So according to bond markets, rates are not going to be hiked anytime soon, not in the next 12 months. Okay, so that's really big. It's not only the expectations for March, but basically we'll need a really superb non-farm payrolls today to so that markets will think that the Fed is going to hike at all in 2016 this year. Okay. Any more questions? Any anyway, we'll get to the wrap-up for today relatively early, and then we'll have the preview for next week's events. Okay. You're still welcome, of course, to ask questions. Anyway, this is the wrap-up for the live market open for Good Friday, February 5th. We had some stabilization in markets after a lot of mess. The dollar that crashed on Wednesday and also yesterday during most of the day found some stability. Some tension towards the NFP is putting a brake on markets, but I believe this will erupt towards the event and, of course, afterwards. Okay, there's light risk-off mood in markets, slightly stronger yen and euro in comparison to commodity currencies in the pound, but not really significant. It's mostly some kind of profit-taking and all those big moves against the US dollar. Something small to watch out for. There's talk about oil inventories reaching full capacity, and oil is stable, but above $30, but who knows what can happen if we hear something real. Yesterday, we had Draginess showing his dovish side once again, not really surprising, and not really impacting the euro because it came at a time of great weakness of the US dollar. Same thing happened with the Bank of England. They voted unanimously for a change against raising rates, and they released a dovish statement lowering forecasts. But yet again, this was not enough to really change the course for the pound. The pound is weakening a bit this morning, but the dovishness of the pound had little effect. Jobless claims, again, more bad figures from the United States. Jobless claims missed, so did factory orders. Hawk in the Fed Mester talked about 4 hikes. In 2016, bond markets, as I showed you, are not pricing any hikes. In Australia, relative stability. Today's big event is, of course, the non-farm payrolls at 1:30. So let's preview this event in short once again. Official expectations stand on a gain of 190,000 jobs against 292,000 last month. Okay. I believe real expectations are a bit lower because of the ISM, because of jobless claims maybe, and despite the ADP NFP. So I believe it's about 170, 180. Second in line to watch, but also very, very important, average hourly earnings. More important, look at the year-over-year figures. It was 2.5 last time. This time it's expected to drop to an annual rise of 2.2. 2.2 I think will be disappointing, also 2%. Anything around 2.5 will be positive, okay? Unemployment rate, important for headlines, less important for markets, is expected to remain at 5%. Perhaps if we have a drop under 5%, it'll be psychologically important, but not really significant. It is the most important thing, again, is the headline figure and then wages, okay? Big event, especially after the turbulence this week. Yeah, okay. And also we have the jobs report in Canada, expected to show modest gain in jobs and the trade balance in the United States and Canada. Worth noting on Monday, but will probably not move markets because we have the US non-farm payrolls. Let's look at charts. And I see we have questions, I'll answer them as well. Currently euro dollar 111.90. I see resistance at 112.15, followed by 112.90 and 113.75. To the downside, we have 111.45 and 110.70. I must say that this new trend in euro dollar is finally moving. Also makes the pair a bit more predictable technically. Beforehand, it was in a very tight range, very choppy, very ugly trading on euro dollar. Pound dollar is now weakening. 145.30 is the current level. 144.80 is what I see as support. On the top side, 146, 146.50, 145.60 is also some kind of resistance, but weaker than it used to be. Dollar yen continues its journey south despite the wishes of the Bank of Japan. Further support 116, probably the line in the sand for the Bank of Japan. 117.30, 118.30, and 120 are on the top side. Dollar CAD was already 100 pips lower yesterday, currently 137.32. finding some stability over there ahead of the NFP. 137.87 is resistance, followed by 139 support, 136.40. Okay, always oil prices matter a lot to the CAD, but today we'll have a break from oil prices because of the Canadian jobs report. Aussie dollar 71.77, in range between 71.40 or 50. No, maybe 40 is more correct. 71.40 to 72.20. Further resistance 72.80. Support 70.50. And the Kiwi dollar fell below 67. Further resistance 67.90 and 69. Support at 65.80. Okay, that's the wrap up. Now we'll make a pause for questions, and then I'll do the preview for next week's events. Okay, so Sinatra tells Jax should print that on 3 on 2 meters canvas, sells for $1 million in your galleries. Yeah, certainly so. Yeah, modern art. Could put it in the Museum of Modern Art in New York. Anyway, the question here: what does a fall in 10 JGB mean? JGBs are the Japanese bonds, Japanese government bonds, but I don't really follow the bond levels of Japan, so can't really answer that question. Anyway, the Japanese central bank is buying bonds in order to lower long-term interest rates, in order for businesses to take more loans and people, so that they'll consume more and lift prices and help the Bank of Japan reach its inflation target of 2%. So it shows up better on Twitter. Yeah, right. Okay. Let's get to the preview for next week. Take a sip of water. So this is the preview for the week of February 8th to February 12th, the second week of February. The main event for next week, I can already tell you, is a testimony by Janet Yellen. 2 days of testimony. So far, all her deputies were speaking out, sending mixed messages, relatively dovish, but now we'll hear from the number one at the Fed, Chair Janet Yellen. But that happens only on Wednesday. Just another thing to mention for next week. It's a Chinese New Year holiday. I don't remember which year it is in China, which animal. If someone can help me out with that, it'll be nice. I'll find it soon. But anyway, we have on Monday a relatively light day, so probably an easier start for the week. And because we have China on holiday, that means less activity, and of course good news for Australia, because when we have news from China, usually it's not that good. Okay. And then on Tuesday we begin getting figures as usual. It's the year of the monkey. Okay, it begins in 2 days and 15 hours. I see something here. So on Tuesday we have the jobs figure in the United States, a complementary jobs figure that adds to the non-farm payrolls. It's a bit old for December, but still worth watching. On Wednesday, Yellen releases her statement. Okay, something to watch out for. It doesn't matter when she actually begins talking. The statement is released exactly on the scheduled time. I think it's 3 GMT on Wednesday, and then she'll also answer a few questions. And on Wednesday, we also have oil inventories. On Thursday, she continues her speech. Oh, why is that missing? Where is the other slide? Oh, sorry about that. Okay, sorry about that. So on Thursday, Yellen continues talking. This time it's more focused on questions and answers. Now it's a presidential year in the United States. That means politicians will do their best to get whatever they can to get her to support their candidates. It should be more of a political feast, but less less about markets. Let's see if she doesn't get angry once again. But she might also release some monetary policy statements. I think Wednesday is more important, but for testimony, but also Thursday. On Friday, we have German GDP. So far, we had a good figure from Spain and okay from France. We'll have on Friday the German GDP alongside Italian and all Eurozone GDP for Q4. Should be interesting. In theory, we should see more growth because of the weak euro. It supports growth in Q4. On the other hand, also the spending on refugees in Germany should be positive for the economy. But, China. So I think it'll be very interesting to watch, very important for the euro and for the ECB. And a focus on the US consumer on Friday, retail sales and consumer sentiment to close the week. The last word goes to consumer sentiment. Anyway, next week is a bit lighter than this week because we don't have these big build up to the NFP, the rate decisions, and we do have the Chinese holiday, but it's still we still have Janet Yellen, and that should be enough for a full week, especially as the market wants hints about the next rate hike, if at all. Okay. A comment here, yeah, the way China has been lately is probably the jackass. Yeah. Yeah, I believe that, we talk, everybody likes to bash China because it's pulling down the world, it's going rogue, stock market is crashing, companies are going bust. It's important to say that China took the baton of global growth in 2008, 2009, pumping a lot of money and helping actually other countries, helping the US stabilize, helping the German export machine. But China cannot do it on its own, and China cannot continue growing at 10% year over year. So it's time for others to take the baton and pump some growth. I believe, I think I told you this before, that at least here in the old continent, the politics of austerity have reached their peak. I don't say we'll see a lot of fiscal stimulus, but we'll see less austerity, I hope and believe. Okay, anyway, I guess that's it for today. Thank you very much, everybody, for coming. Sorry again for the small delay. Wish everybody success today. Remember, there's no obligation in trading the non-farm payrolls. If you see an opportunity, go for it after the event, not before. And if you anyway, it's a lot of volatility. It's a lot of unknowns. We already had a big move. I believe we could see more big moves in markets this week. The tendency, I believe, is still against the US dollar, but let's see if we have a really positive figure. Things could improve. One thing I liked about this week is finally I talked a bit less about risk on, risk off, and US dollar up or down. In this week's case, down. Okay, so thank you very much, everybody, for coming. Hope to see you also in the live coverage that FX Street is doing, and I'm participating. It begins at 1 GMT, half an hour before the event, with our team. I mean, I'm part of the team of Dale, Valeria, Mauricio, and have a great weekend as well. And see you on Monday as usual. So thank you. Have a great weekend and bye-bye.